Hey people, the Fed just cut interest rates for the first time in years. Here's what you need to know on how it impacts your money, your debt, your goals, and even your savings. This is a finance quick fix from Prophet Nick. Let's get into it. Before I jump into how it impacts you and your money and what you should be doing, let me give you a bit of context on why this matters. The past few years, the Fed has been going up on interest rates to try and slow inflation, which was up. So this is basically how fast prices were going up on stuff like groceries, gas, and everything we've been feeling in our pockets. So when prices started going up fast, they went up on interest rates and raised the rates to make loans, like for cars, homes, some credit cards, etc., more expensive. When people take out fewer loans and spend less, ideally it helps slow down how fast prices are rising in the economy. But now inflation is starting to cool off and come down as prices on these everyday things finally start to come down, right? So the Fed is bringing down the interest rates to make loans cheaper again. And the goal here is really, since prices aren't rising as fast anymore, they're making the loans more affordable so people feel more comfortable getting those home loans, getting those car loans, and using their credit cards again while they're outside. They may keep lowering rates over the next few months depending on how things go to keep the economy moving in the right direction. So now that we got the context, here's how this interest rate cut directly affects you and your money. Credit cards. Most credit card interest rates are variable, so the interest rate is changing. So because of this interest rate cut, your credit card interest could go down over time. If you've got a balance, your rate won't drop instantly, but if interest rates continue to go down, you'll start seeing smaller and smaller interest charges, which means more of your payments will go towards reducing the actual balance that you owe and not just the interest. And this is a good thing because that credit card can get paid off even faster with more of your payment reducing what you owe. Let's talk about student loans. So for federal student loans, that's Sally Mae and them, nothing's going to really change. But if you've got private loans, like through a bank with a variable interest rate, this drop could mean that you're paying less in interest, leaving more money to go towards paying down your actual loan balance. So a similar situation as the credit cards. And so here's a quick tip. You can look on your monthly statements, usually near the end, to see what your interest rate is and if it is variable or not. It will usually have the letter V beside it. So this means your interest rate changes often or is variable. And so with this Fed interest rate cut, it just means that that rate change, that variable, will likely go down, which is good news for credit and loans. Let's talk about cars and home ownership. So if you already have a car loan or a home mortgage, your rate is going to stay the same. This is unless you refinance in the future. But if you are shopping for a car or a house soon, I am talking to you. This is great news. These lower interest rates could continue to mean smaller monthly payments on new car and home loans. Now let's talk about your savings accounts. The Fed cuts are great news for loans and not so great news for savings. Since the Fed is cutting rates, your savings accounts will likely earn less interest. So in other words, your money won't make as much money from interest as it used to. And so this applies to things like high yield savings accounts, CDs, money market accounts, etc. So definitely keep an eye on those numbers in the coming months. So how can you make this work for you? What should you do next? You can pay down debt. So you can focus on paying down that high interest credit card debt. As the rates drop, you'll pay less in interest, which means you knock down your debt faster. Let's talk about big purchases and goals. If you are in the market for a car or house, watch for even lower rates. Lower rates mean lower monthly payments. So don't rush, but be ready to act because we plan to see more rate cuts over the coming months. Now let's talk about savings. If your savings account is earning less, think about other ways to grow your money. High yield accounts still work, but it's worth looking at options like investing. And if you want to get started investing and need a great first stock recommendation, check out this quick 2-minute video I've linked. Here's the takeaway. The Fed is cutting rates, and this means loans are getting cheaper, but your savings might not grow as fast. And with inflation coming down, prices on those everyday items should continue to come down too. So stay on top of your debt, time your major purchases and goals wisely, and make sure your savings and money you're setting to the side to grow are working for you. I want to make sure you know simply what these type of changes mean for your money and goals, not legal or investment advice. Let me know if you have any questions in the comments, and subscribe for more many ways to make your dough grow in simple ways.